95% of traders think they understand liquidity. They think it's just about volume. They're wrong. And that mistake is costing them a fortune. If you've ever had a trade look perfect, only to see price move just far enough to hit your stop loss, and then instantly reverse and go exactly where you predicted, you weren't unlucky. You were liquidity. Every major move in the market, every massive run, every violent reversal, is fueled by one thing: liquidity. The big players, the smart money, they don't buy or sell, they hunt. They use the stop losses and pending orders of retail traders like you as the fuel they need to execute their colossal trades. I'm going to take you behind the curtains. I'm going to show you where the smart money is shopping, where they are hunting, and how to identify these zones before the price gets there. This isn't just a lesson on what liquidity is. It's a guide on how to stop being the prey and start trading alongside the market's true movers. What is liquidity, really? Let's start with the official definition. What is liquidity? What does it really mean? Liquidity is the ease with which an asset can be bought or sold without affecting its price. But for us, for traders, liquidity is fuel. It's critical you understand this. Every pending order and every stop loss placed by a retail trader is fuel for the smart money. When a massive institution wants to buy $1 billion worth of assets, they need sellers. Those sellers are you. They need pools of readily available counterorders to execute their trade without spiking the price too much. Now we get to the core move: the liquidity sweep, or the stop hunt. This is the aggressive fake-out move designed to pull in all the resting orders. Look at this chart. We have a clear swing high. Retail traders have placed their buy stops just above that level, anticipating a breakout. The market maker sees this stack of orders, this massive pool of buy-side liquidity. Price moves up violently, sweeps that level, triggering all those buy stops and taking out the seller's stop losses. Notice the candle, it often has a long wick and fails to close decisively above the level. The smart money has now filled their massive sell orders using their triggered buys. They have their position, and the market no longer needs to move up. The fuel has been consumed. What happens next? A rapid reversal. If the sweep is legitimate, price will quickly drop back into the previous range, signaling that the move was purely to collect liquidity, not to continue the trend. This is your key to confirmation. We've established that the market sweeps liquidity for fuel. But where is the engine driving the car? The answer lies in market imbalances. We need to talk about the fair value gap, or FVG. An FVG is simply an area on the chart where price moved so fast that it didn't trade on both sides. It represents inefficient pricing, a void the market must eventually return to. Think of it this way. Liquidity is the igniter. The imbalance is the magnet. The smart money needs the sweep to enter their position at a great price. But they enter with the expectation that the market will move to fill the nearest, most accessible imbalance. Let's look at a concrete example. Here, we see a clean pool of sell-side liquidity. Under these equal lows, the price executes a perfect liquidity sweep, pushing down just enough to trigger the stops and fill institutional buys. Immediately following the sweep, what is left behind? A massive fair value gap to the upside, created by the aggressive move. This fair value gap is now the market's true target. Our high-probability trade setup isn't just betting on a reversal. It's anticipating the market's need to correct that imbalance. The sweep confirms the bias, and the fair value gap gives us a precise entry target and a minimum profit target. You now understand the why. Now, let's nail the how. This is the 4-step execution sequence for trading a liquidity sweep. Step 1. Before anything happens, clearly mark your target liquidity pool. Is it an area of equal lows, a major daily high, or a clear trend line? This identifies the smart money's intent. Step 2. Wait patiently for the sweep. The price must aggressively push through that marked pool. Crucially, look for the rejection. A strong move back into the range, often leaving a long wick, confirming the stop-loss collection is complete. Step 3. This is your primary confirmation. After the sweep and rejection, you must see a market structure shift. If we had a bearish sweep of buy-side liquidity, we need to see a recent low broken, confirming the shift from bullish buying to bearish selling dominance. Step 4. Entry. Your highest probability entry point is often within the fair value gap or the last strong order block created by the market structure shift. Price often returns to fill this inefficiency before continuing the new trend. So, in summary, sweep confirms bias. Market structure shift confirms structure. And the fair value gap gives you the precision entry. This entire sequence flips the script, allowing you to enter the market after the big players have finished their hunting. We have the strategy. But a strategy without proper risk management is just gambling. When dealing with liquidity, stop placement is the single most important factor. Rule 1. Never place your stop loss exactly where the obvious liquidity is. Why? Because that is the zone the market is designed to sweep. Putting your stop loss just below an equal low is painting a target on your back. Instead, use the structure created after the sweep. If you are entering on an fair value gap, place your stop below the low of the candle that caused the market structure shift. Or better yet, below the extreme low or high of the liquidity sweep itself. This gives you maximum protection. Always use fixed, low percentage risk per trade. Ideally 1% or less of your total account balance. High probability trades are still subject to high volatility, which is inherent in liquidity sweeps. Protect your capital. Your profit target should always be the next clear, opposing liquidity pool or imbalance. If you entered after sweeping sell-side liquidity, your primary target is often the nearest high of a previous structure or a large fair value gap above. We have covered it all. You now know that liquidity is the fuel. You know how to identify the pools, the buy-side and sell-side targets. And you have a 4-step strategy to enter the market. After the hunters have done their work. Your homework. Go to your charts right now. Find 5 recent examples of liquidity sweeps on the 1-hour or 4-hour time frame. Mark the pools, identify the market structure shifts, and see if an fair value gap entry was present. Don't trade it yet, just see it. If this tutorial opened your eyes, hit the like button and subscribe for more advanced trading education. Let me know in the comments below. What is the biggest liquidity mistake you've made? Thank you for joining me. Now go out there and stop being the liquidity. I'll see you in the next lesson.